Students come to me and ask all the time, what is the easiest entry model / entry time frame? Today, I'm finally going to dive into what time frame I normally use to enter a position. Now, this entry model is so powerful when used in the direction of daily bias. Okay, so when we have a daily bias, this entry model appears all the time. You just have to know when to trade it. Okay, so let's dive straight into this without wasting any time and show you what the entry model is first. Put simply, we are working around a time because time, then price. What time is this on Forex pairs? It is 8:30 a.m. 8:30 a.m. is when a big volatility injection comes. This is when the news embargo is lifted. So the news embargo is lifted, which means the algorithm has volatility working for it. Okay, so if it's reaching for a certain price level, in this case, we are reaching down here. If the algorithm is reaching for a certain price level, the volatility injection allows it to go there. What is the entry technique? Okay, so you may be familiar with the fair value gap. We have a shift in market structure when we break a low here or here, when we break a low with displacement on the 5-minute time frame. Okay, the 5-minute time frame is one of the easiest time frames to get an entry off of. If you're working off of a key level, so we've either ran buy side or sell side liquidity, a key PD array, so a premium array in this case, and you have displacement, this entry model is the easiest thing you will ever find, and it offers the highest risk to reward that I've found. Okay, so we are working around 8:30. You are never, listen to me, you are never taking this entry model before 8:30, only after it. So we break lower, displacing, we rally back and mitigate the fair value gap. We are not taking a trade here. Personally, I don't do this. I'm waiting for now a change in the state of delivery. Lots of you know what a change in the state of delivery is, but put simply, it is when we come down into a key level and then the next candle closes above the last candle. So this down close candle now becomes our bullish order block. In this case, I'm waiting for a bearish order block. Look what happens if we zoom in here. At about 9:25, we fully fill the fair value gap. So the top end of this fair value gap has been mitigated. Now I am waiting for this 9:25 candle, and this is why I work on the 5-minute time frame, because I won't be waiting that long. I'm waiting for this candle to close below this candle's body. As soon as it does that, we now have an order block. We now have a change in the state of delivery. Okay, so this becomes our order block. So the last up close candle before the move down becomes our order block. Any rally into this up close candle here, I am selling. So really, you take the whole length of the order block, but ideally you want the body. The body of the order block is the sensitive area. It is sensitive because that is where the volume lies. The volume lies in the bodies of candles. Wicks do the damage, the bodies tell the story. So any rallies into this level, I am selling. Okay, we would sell there. As soon as we tap the order block, your stop loss will go above this high. Why this high? Because it fully mitigated the fair value gap over here. Now remember, this is similar to the 2022 model, but with extra confirmation. Those of you who have watched ICT's 2022 mentorship are familiar with the displacement and then the fair value gap. But I'm taking it a step further. I want extra confirmation that we are going lower. We need this change in the state of delivery. As soon as we get that, you can enter a position. You could aim for the sell side liquidity down there. Stop loss would go there. Aim for the sell side liquidity at the low. So London's consolidation. We have London consolidate, a rally higher, dip back down into equilibrium of this price swing. Okay, rally once more. Potential high of the day is in place. 8:30 displaces, come back up, fill the fair value gap, and then we have a change in the state of delivery and look at the bearish momentum throughout there. An easy 1 to 4.2, just using this entry technique. Okay, but you have to outline logic beforehand. Why should price reach down here? What daily profile is in play? Well, we have a London low of the day so far, and then we reverse. So it's a New York reversal. New York reversal, take out London lows. London consolidation, accumulation, reaccumulation, smart money reversal, lower sell, distribution, redistribution. Okay, this is a market maker sell model. Those of you who are familiar with market maker sell models will have seen that and recognize the levels of distribution and accumulation I just pointed out. That can be overcomplicated, but I want you to also look at this level. Okay, this breaker here, we fail to displace below the breaker, we rally higher, and then you would be selling. Usually this would break the low and tap the breaker on the 1 minute chart. You would also be selling that. But if you're in a position that is more than enough. Okay, so this is the entry technique. We are simply going from, let's say, price displaces, fair value gap, then our order block. Okay, this, and ideally you want a short-term high tagged as we mitigate the fair value gap. Okay, so these are the two entry models I pretty much use. A fair value gap will rest there, and then this becomes an order block. Here, a fair value gap will rest there. Ideally, you want a short-term high below the fair value gap, because this way you are inducing buyers as well. If we rally higher here, people are buying this up, okay? But people have bought this. As it breaks lower like that, their stop losses are here. When we rally it once more, we take out all the buy stops there and the stop losses of people going short, mitigate the fair value gap, and then give our order block. Okay, that up close candle inside here would be your order block. So with that being said, let's dive into some more examples of this occurring. Let's look at USDJPY here on the 5 minute chart, of course, with a directional bias. So we are prone to go higher. We are reaching for liquidity up here, and there's further liquidity back there. Okay, there's a daily fair value gap that I want to bring your attention to. This right here is what we are aiming for. Okay, that is the drawn liquidity. So once we're down here on the 5 minute chart, waiting for the volatility injection, we have in our mind that the draw on liquidity is higher. You are looking for buys. Okay, now midnight New York is back here. We rally lower and then get a spike higher. If you take this range low to this range high, you can see we come back down into a deep premium during New York. New York 8:30 spikes higher. We have news, okay? And then look what we do. We start to build lower. We are working inside of this fair value gap. So price has been delivered here on the upside, downside, up, and then once we're here, so once we're at 905, price has not mitigated from here to here. All of this is buy side imbalance, sell side inefficiency. So we are waiting for price to come back into our fair value gap, which is obviously this. This is your whole fair value gap, but because of the function I just explained, how we went higher, lower, higher, this portion is what I'm focused on. So this is the portion that hasn't been delivered on the sell side. Remember what I told you, we go from a fair value gap to an order block. So we are looking for the fair value gap. And by the way, this is the same thing I just told you, right? So we have short-term low put in, and then we break the short-term low into the imbalance. Remember I told you that is the ideal scenario. The ideal thing that happens is we tag a short-term low, because now people who have bought this little rally in here have their stop losses here. Now they're tagged in. Also, breakout traders are going short. They think we're going down here once we break the low. We mitigate in this area inside here. And then what are we waiting for? We are waiting for an up close candle to close below the last down close candle. I'm not using this candle because it's pretty much all wick. We want a big, large body candle. Okay, that candle gets ignored, this one too, because it's pretty much all wick, like I said. And if you recall earlier, I said wicks do the damage, the bodies tell the story. So when we have a larger body here I am focused on this large body. Once this candle displaces higher, closes above the high of this candle, or at least the body of the candle, okay, in this case it was clearly the high, then we rally back down. If it's partnered with a fair value gap 2, that's extra confirmation. That makes it even more high probability. It's a little gem in there for you. But nevertheless, you are longing this here. Stop loss goes where? Simply below the low that mitigated the fair value gap. We don't want any rallies back down here now because of the time aspect as well. So we are pretty late in New York session at this point, 9:55, okay? 9:55, I would stop trading around 11:30 New York time, okay? So price, if it is to get back up to this high, which would be one target, if it is to get back up to this high, it would need to do so quickly, right? Because we are at the end of New York. So if it were to come back down here, what are the odds of it then rallying up here? Pretty low. It's likely to start consolidating if it comes down here. So we don't want it to come below the low, simply because of the time of day aspect. Remember, I always tell you time before price. This is part of that. If we're to the end of the New York session and you still want price to get somewhere, it needs to do so quick, okay? It needs to start pumping up and start taking out buy stops. The algorithm knows this, okay? The algorithm knows what it is doing. It knows that it is 9:55 right now, and it knows that the buy stops rest up here. How can we punish the most amount of early sellers in this market? By sending it from this order block. So this low shouldn't be violated. That's where our stop loss goes. You would target 10-20 pips above this high. Okay, so usually target the high, about 10 pips above the high, and then 10 pips above that, which is 20 pips. Okay, start using 10 pips above a high and 20 pips above a high. So this would be your target. And look where price coincidentally goes to. Okay, 1 to 2.6, easy. You're in and you're out by 12 p.m. Okay, if you start to see a drop lower, remember we are just collecting more orders here. When we drop lower, take out this, we are collecting more orders to send it higher into the institutional levels above the buy side liquidity. Okay, there's another little gem for you guys. So 10-20 pips above or below your liquidity targets, you can really push for those levels. Institutions like to use the big figure numbers, so 150.2, 150.5, these sort of levels, that's what they're interested in. Okay, with that being said, I will let you digest that model. If you want to become my student today and join my mentorship, trade with me every week and every day, you want to learn more about these concepts, please do join my mentorship. It is the top link in my description. Spots are limited, as I keep saying. The mentorship is closing by the middle of November. So if you want to be my student, the time is now. Nevertheless, if you did enjoy the video and want to support me anyway, please drop a like and subscribe, share with friends, and turn on post notifications so you never miss a video. Drop a comment with any feedback, and as always, I thank you all for watching, and I'll see you guys in the next video.